Assalamu alaikum everyone. Welcome to ACCS Prepare to Pass. I'm your trainer Hamza Abdullah and we will be going through the session of the paper SBR today. Can everyone hear me properly? Just checking the mic before starting the session. Can everyone hear me properly, all of you? Okay, that's good. So let's start the session. So welcome to Prepare to Pass for the paper of SBR. I'm your trainer Hamza Abdullah. I have shared my website, my Facebook ID and my contact number so that in case any one of you wants to contact me, you can contact on these details. Just a brief profile about myself. My name is Hamza Abdul. I teach the papers financial reporting, financial management, and strategic business reporting. And I've shared a group link for the discussion forum. So so you people can join by clicking on this link. If you are unable to click on this, you can contact the admin or you can contact me personally to get the link to you. I'm an ACC member. I have experience from Deloitte, Pakistan, and have been teaching ACCA since last 10 years. And I have produced multiple nationwide positions in different attempts. And even I have produced twice P2 positions in a single attempt. And historically, I've been producing my pass rates above the global pass rates throughout my teaching career. And I've been conducting multiple training sessions on IFRS, which have been officially conducted by ACCA and the ICAP. ICAP is the Institute of Chartered Accountants of Pakistan, the chartered accountancy body of Pakistan. So let's start with the paper pattern, how the paper is going to be, what are you people going to be asked and how you are going to attempt that. Just an overview about the paper. You're going to have two sections, section A and section B. Both sections will be of 50 marks each and having two questions in each of them. Question number one is going to have an area of consolidation and different accounting standards. In question number two, you're going to have the accounting standards again, but this time instead of consolidation, you're going to have the area of ethics. Question number one will be around 30 to 35 marks. The exact number of marks have not been declared by ACCA. And question number two will be in between 15 to 20 marks, depending on the question one. So if question one is of 30, question two is going to be of 20. If question one is of 35, question two is going to be of 15 marks. Both of these questions are going to include the accounting standards. In question 3 and 4, just give me a minute. In question 3 and 4, again, you are going to have the area of accounting standards, but this time the area combined is going to be either analysis or it is going to be the area of current issues. Apart from this, the accounting standards may include the area of framework. You may also have the area of framework in this. So in total, if we divide the course, let me use the PowerPoint this way. So if we divide the course, we are going to say that the course includes the area of consolidation. The course includes the area of ethics. Just give me a minute. Okay, so the course includes the area of consolidation. It includes the area of ethics, the area of accounting standards, and the area of framework and the current issues. So in total, the course actually lies in between these two: consolidation, ethics, standards, framework, and the current issues. So these are the five major areas of SBR. Okay, Mohammed Nabil is saying Assalamu alaikum. Wa alaikum assalam, Mohammed Nabil. Sir, I benefited from your F7 webinar. Thank you so much and was successful and inshallah optimistic about SBR. Inshallah, Mohammed Nabil, you will also pass in the SBR. I will try my level best to use these 15 hours of the session to provide maximum knowledge. So these are the five areas which are going to be examined. Now, if we see, the area of accounting standards is going to be there in every question: question 1, question 2, question 3, and question 4. But these two areas are going to be comparatively easier as compared to the area of section B. So the standards that the examiner asks in section A are comparatively easier than section B. And the area of consolidation and ethics are also comparatively easier. So section A is um, section A is basically the session which is the easier part of the paper, and we have to attempt this well to ensure that we are going to pass. So these are the passing areas. So if you're good in consolidation, you're good in ethics, you are good in accounting standards, this means that you are good in SBR. Comparatively, in section B, when we talk about the analysis and current issues, this is a bit difficult area for the students because this actually requires your analysis, your skills. And the other areas actually require more of knowledge. But in analysis, you need the analytical skills to ensure that you can analyze the information given in the paper. So I personally recommend that students tend to or should try to focus more in on section A as compared to section B. This will help you people pass the paper more easily. So now if we discuss the capabilities which are required in the SBR, these are the same which I've mentioned in the previous slide. We are going to use ethics, fundamental ethical and professional principles. We are going to have the area of framework. We are going to have the area of um, reporting the financial performance of range of entities. This basically means the accounting standards, IESs, and the IFRS. We have the group financial statements, which means the area of consolidation. We have the area of analysis. Interpretation means actually analysis. And we have the impact of changes in accounting regulation, which means the current issues. So these are the areas which should be part of the course and which should be learned before going into the exam. Now, if we further divide these areas into a more detailed sheet, I'm going to say that in ethics we have the professional behavior of the accountant and the directors, the ethical requirement, and the consequences of being unethical. This is something which is also very important and should be written in the exam. That what are the consequences of being unethical? In the area of framework, we are going to apply this framework onto different accounting standards, and we're going to discuss the strengths and weaknesses of the framework. And when we talk about the area of accounting standards, we have revenue, which is IFRS 15, which have financial instruments, which is IAS 32, and IFRS 9. We have leases, which is IFRS 16. We have employee benefits, which is IAS 19. We have income taxes, which is IAS 12. We have share-based payments, which is IFRS 2. We have fair value measurement, which is IFRS 13. We have non-current assets, which include 16, 23, 40, and 36 in IFRS 5. We have provisions and contingencies, which is IAS 37. Events after the reporting period, which is IAS 10. We have the reporting for SMEs, and we have some other areas as well, such as IFRS 8, IAS 34, IFRS 1. All these are being covered in other reporting issues. But if I tell you the major standards which you should be covering for SBR, this is going to be IAS 19, which is employee benefits. It is very important. We have IFRS 2 financial instruments. We have IFRS 2 is share-based payments. We have IAS 32 and IFRS 9, which is financial instruments, and IAS 12. These four are the most important areas of the paper. Apart from this, we have IFRS 15, we have IFRS 16, we have IFRS 13, we have IAS 36, 37, 38, and IFRS 5. These are the second priority areas of your course. And apart from this, we have IAS 24, we have IFRS 8, we have IFRS 1, we have IAS 34. These are the third priority areas. So this is going to be the first priority area, this is going to be second priority area, and this is going to be the third priority area. And if I tell you this is something which is same as the course of P2, so you can refer to the P2 webinars which were there before for the accounting standards area, but you cannot refer them for the remaining areas. So the accounting standards can be referred from the P2 webinars, but the remaining areas should only be referred from the SBR webinars. So I've taught approximately 5-6 P2 webinars, and you're going to find that in the sheet which is going to be sent by the ACCA, having all of the details of the webinars. And then when we talk about the preparation of the financial statements, which means group financial statements, we have the group accounting, we have the accounting for associate and joint arrangements, which is IFRS 11. We have foreign transaction and entities, which is IAS 21. Apart from this, in analysis, in the interpretation area, we have additional performance measures, which is called APMs. This is also one of the important areas of the course. And then we have the current issues, and there are different current issues, which includes the current issues on the materiality, which includes the current issues on the disclosures. These are some of the important current issues because these are something which are also linked with the framework as well. So we have another current issue relating to the framework itself. So these are three comparatively more important current issues. Roshan is saying 0092 means code for Pakistan. Yes, Roshan, exactly. Okay, a lot of people are facing the problem to join the WhatsApp group. You can actually send me a personal message on +92 334 3739 697. You can send me a personal message on WhatsApp on this number. I'm going to send you the link so that you can join easily. Okay, so now what is the session plan that we are going to follow? We are going to invest our first 2 days in the major accounting standards because these are the areas which the student find more challenging as compared to the remaining ones. In day 3, we are going to solve the area of consolidation. In day 4, we are going to solve the past papers along with the other accounting standards. So in this June 2019 session, we are going to focus more on the accounting standards and the area of consolidation. Now, there's a question that why I am not going towards the analysis and the current issues and the ethics. The reason is that the reason is that I have already covered these areas in the previous session of March 2019, which was the previous session of SBR. So I have provided the links. In day 1, I had covered the consolidation. In day 2, ethics. In day 3, analysis and interpretation. In day 4, I had covered the framework and the current issue. So all these links are available to you people. You can refer to these in the previous webinars. So if you cover both the webinars of March and June, you are approximately covering the major part of the course. So, rather than discussing the same areas again in June, I thought it would be a better plan to discuss the areas which were not there in March, so that the students can actually refer to both of the webinars to 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 actually utilize the maximum. Okay, Mohammed Nabil is saying to go on to this slide. Nabil, you can take the snapshot quickly. Usman Qureshi is saying, will we do IFRS 9? Usman, we will try to cover IFRS 9 too, depending on the time. If we get some safe time in day 1 and 2, we are going to start with IFRS 9. So IFRS 9 will be there, but I will be more focused on the important areas of that, like the impairment areas or the hedging areas, because that are more challenging ones. Okay, Shunil Said is saying, where can we find the accounting standard webinar? Shunil, I will provide you the links of those webinars on the WhatsApp group. Okay, so let's start the session with the accounting standards, and we are going to solve IAS 19 employee benefits. Usman is saying, please guide exam techniques as it is my second attempt. I have figured time management is issue. Can you please guide on that? Yes, Usman, basically the paper of SBR is a lengthy paper, and what needs is to manage the time well. Like for example, if you have a question of 10 marks, you are having 1.92 minutes per mark. So approximately your timing should be 19 minutes, which includes the reading, planning, and writing. So if I break it, you should be reading the question in 5 minutes and writing the question in approximately 15 minutes. So we are going to solve the past papers. The reason the last day I have written for the past papers only is that I would want you people to solve at least one complete exam from question 1 to question 4, because that will help you people more that how to go for the paper, how to understand that, how to write that. So day 4 is basically about the past papers practice, because we are going to solve a complete paper in that, and we are going to discuss the standards which were actually asked in that exam. So this is why I have planned day 4 as a complete past paper day, so that we can understand the overall paper, how to manage that, how to take that. Okay, so let's start IAS 19. When we talk about IAS 19, there are different types of benefits. We have short-term benefits, we have long-term benefits. Short-term benefit means benefits which are going to be paid to the employee within the 12 months. Short-term benefit means benefits which are going to be paid within 12 months. Long-term benefit means which are going to be paid after 12 months. So if we are paying an annual bonus to the employee, is it short-term or long-term? If we are paying an annual bonus to the employee, is it short-term or long-term? What do you people think? If we are paying an annual bonus, short-term or long-term? Usman is saying short-term. Okay, Christopher is also saying short-term. I want replies from you people, because I want the session to be interactive, so that I can understand what you people are thinking, and accordingly I can um, discuss things. So yes, everyone is saying short term because it is an annual bonus, because that relates to 12 months. But what about a bonus which is going to be paid every 5 years? If you're paying a bonus every 5 years, it is short term or long term? It is long term, exactly. Good. So any bonus which is an annual bonus, it is a short term. More than 12 months, it's a long term. And any benefit which is going to be paid at the time of termination is going to be called the termination benefits. Termination means forced. Termination means forced retirement or forced redundancy. It is not going to be an intentional. If an employee is leaving intentionally, that is not a termination. Termination means that we are forcing the employee to leave. So if we are forcing an employee to leave, that is going to be called a termination benefit. So short-term benefits relates to less than 12 months. Hiba is saying, where can I respond to the lecture questions? Hiba, you can exactly respond over here where you're asking the question, because I can see the messages that you are typing on the question box. So you can simply write anything that you want to communicate to me. Now, when we talk about the long-term benefits, the long-term benefit may be a post-retirement benefit which is going to be paid after retirement, or it may be an other long-term benefit. Other long-term benefit means which relates to more than 12 months, but is going to be paid before retirement. Relates to more than 12 months, but will be paid before retirement is called other long-term benefits. Now, if I tell you about the past papers, the short-term benefits has only been asked once in the past papers. The other long-term benefits has only been asked once in the past papers, and the termination benefits have never been asked in the past papers, which means that majority areas are being asked from the post-retirement benefits. So this is the most important area of IES 19. So we are going to focus more on this part of IES 19 because this is something which is asked the most. Okay, a lot of people have posted messages on the WhatsApp. So I will be replying to those after the session, obviously, because right now I will not be able to reply to them. So approximately 41 messages received so far. So I will try to reply to all of you people by the day and today, specifically with the WhatsApp group link. Okay, Roshan is glad to start with these topics. So we are starting the post-retirement benefits. Now, when we talk about the post-retirement benefits, what happens is that the company actually makes a fund in which the company transfers an amount which is called a contribution. The company is going to transfer an amount which is called the contribution to the fund. Why? To provide post-retirement benefit to the employees. And how the employee is going to receive this post-retirement benefit is that the company is going to transfer Can you people hear me now? Yes, okay, that's good. So now the voice has been restored. There was some problem in that. So let's continue. We were actually discussing that the company makes a contribution into the fund. And what does the fund do? The fund actually invests that amount into different investments. These investments can be some equity investments or can be some debt investments. That depends on the fund. Now, fund has to make investments and to increase the value of the amount transferred to it. So, for example, if a company is transferring $10,000 to the fund is going to invest this amount until the employee gets retired. And the fund is going to try to increase this to 12,000, 15,000, 20,000, 25,000, 30,000, 40,000, so that when employee retires, he can get the maximum amount. But the problem is, what if, and this benefit is going to be paid to the employee when it is retired. And this benefit, this amount, the $10,000 which has been invested and converted to, let's say, $40,000 is going to be paid to the employee at the time of its retirement. But obviously this 10,000 is going to be an annual amount, and every year the fund is going to increase its investment and multiply this 40,000 into multiple values. So the company contributing to the fund annually, the fund is making the long-term investments so that whenever the employee retires, the benefits can be paid to the employee. Now, what if there is a loss on the investment? What if the fund actually converted the value into $2,000 only? It got 10,000 from the company. It made some good investments. The investments were generating profits, but somehow it made a loss, and now the amount has been a loss. We, and we can even assume that the entire amount has been incurred in a loss, and now the fund has no value, zero. Now, when the employee retires, the fund does not have anything. The fund is zero. The question is that who is going to bear the risk? Will the employee bear the risk or the company bear the risk? What do people think? If there's no amount in the fund at the time of retirement, who is going to bear that risk? The employee or the company? George is saying employee. Usman is saying fund. Nabil is saying company. Christopher is saying company. Roshan is saying maybe both. And everyone else is saying company. Actually, this depends. Actually, this depends. If the employee bears the risk, if the contract says that the employee is going to bear the risk, we call this plan a defined contribution plan, which means that the company is liable only to contribute into the fund. And once it has given the amount to the fund, the company is no more liable for anything, because now the risk belongs to the employee. If there's a loss, the employee is going to bear the loss. So if the employee is bearing the loss, we call this a defined contribution plan, where the company is obliged, is liable to contribute only. But if the company bears the loss, we are going to call this a defined benefit plan, which means the company is liable to provide the benefit. So this is the extent of liability actually. If the company's liability is up to the extent of contribution only, we are going to call this a defined contribution plan. The company is no more liable after giving the amount to the fund, after contributing the amount into the fund. The company is no more liable. But if the company is still liable, and if the loss is being done by the fund, the company is going to the company is going to bear the loss. We call this a defined benefit plan, because in this the company is liable until the benefit is given to the employee. Are you people getting this? If the employee bears the loss, this means it's a contribution plan. If the company bears the loss, it means it's a benefit plan. And who's going to bear the risk depends on the contract which the employee and the company have taken with each other. So now if we talk about the contribution plan, if we call about the defined contribution plan, after fixed contribution, company has no further obligation. After paying the fixed contribution, the company has no further obligation, um, and any risk will will belong to the employee. So we can even say that the investment risk, the risk of investment done by the fund. Investment risk means the risk of the investment done by the fund are assumed by employee or third party. Third party means maybe some insurance company. So the investment risk is assumed by the employee or the third party. And in this, the benefit will depend on the assets of the fund. The more the assets, the more the benefit the employee gets. The less the assets, the less benefit the employee gets. No assets, no benefit the employee gets. So in case of defined contribution plan, the company has contributed and it's no more liable. In case of defined benefit plan, it may still be liable. Now let's change the case. If we talk about the defined benefit plan, the employer, which means the company, is unable to show that all actuarial and investment risks have been transferred to another party. If the company is unable to show that it has transferred all the risks, then it is called a defined benefit plan. Then it is called a defined benefit plan. And in this, benefit is normally a predefined formula. Like for example, we say to the employee that you are going to get 10% pension of the last salary. You're going to get 10% pension of the last salary until you are alive. This is the benefit that we are going to pay. You're going to get 10% pension of the last salary until you are alive. So now this is the benefit we are going to give. The benefit is a predefined formula, irrespective of the amount which is there in the fund. If the fund has $10 million, if the fund has $10 million, if the fund has $10 million and the benefit becomes $2 million, the employee will only get 2 million. The employee is not going to get the amount in the fund. But if it's a defined contribution plan, in case of contribution plan, if the fund has $10 million, the employee is going to get $10 million. If the fund has $5 million, the employee is going to get $5 million. If the fund is $2 million, the employee is going to get $2 million. If the fund is zero, the employee is going to get zero. So in contribution plan, the benefit depends on the fund. This was the third point, Roshan. In case of defined contribution plan, the benefit depends on the fund. But in case of defined benefit plan, the benefit is a predefined formula that is going to decide what amount is to be paid to the employee. Getting this, everyone? If there's any question in the identification of the plan, you can ask. Roshan, is the third point clear now? Okay, so no question so far. Krishna is saying no question. Roshan, have you understood this third point? Okay, good enough. So now we are making a summary of both the plans. We have two plans, contribution plan, benefit plan. In contribution plan, company pays a fixed contribution and has no legal or constructive obligation for any further payments. The company pays a fixed amount and then it is no more liable. In case of benefit plan, we say that the plans which are not defined as contribution plans are classed as benefit plan. So benefit plan actually does not have its own definition. Rather, any plan which is not a contribution is a benefit plan. Any plan which is not a contribution plan is a benefit plan. And in case of contribution plan, the actuarial and the investment risk of defined contribution plans are assumed either by the employee or the third party. Either the employee is going to be at the risk or third party is going to be at the risk. Now let's suppose I have a question with you people. If you don't have any question, then I have a question. There's a company and the company actually pays the amount to the fund. Fund invests the amount and earns a return. The company has made a contribution. The fund makes an investment, gets the return, and pays the employee the benefit. Now, if I say that investment risk means the risk of a loss on the investment made by the fund. If the investment risk belongs to the company, This means it's a defined benefit plan because the company is going to be at the risk. Plus, what the company does, it actually goes and gets an insurance of itself that if the fund defaults, the insurance company is going to be at the loss. If the fund does not have the funds, does not have the amount, the insurance company will pay the amount to the employees. Now, is this a contribution plan or a benefit plan? The company had the investment risk, but now it has transferred the risk to the insurance company. Is this a benefit plan or a contribution plan? Okay, Raj is saying benefit plan. Musharraf is saying contribution plan. Shazad benefit. Hamza saying contribution, benefit, benefit, contribution, benefit, 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 contribution. Okay, so we have a mixed answer. Actually, this is still a defined benefit plan. This is still a defined benefit plan. This is still a defined benefit plan. Why? Because when we go for insurance, the insurance can minimize the risk. It can never eliminate the risk. The insurance can never eliminate the risk. It actually minimizes the risk because what if even the insurance company defaults? What if the fund defaults and the insurance company also defaults? If both of them defaults, is the company liable? Yes, this means it's a benefit plan because the company should have no further obligation for it to be a contribution plan. So even if we have done an insurance, the insurance will minimize the risk but will not eliminate the risk. Therefore, we are still going to call this a defined a defined benefit plan. So this is one of the areas which has been asked in the past papers by the name of Alexandra, where we had a company Alexandra which insured itself for a defined benefit plan, and then it said that it's a contribution plan because of the insurance. So in the answer, the students were expected to write that even despite of insurance, the risk has been minimized, but it's not actually eliminated. So we will be solving some past papers at the end of the standard, but let's right now focus more on its understanding. So if an employer is unable to show that all actuarial and investment risks have been transferred to another party, its obligation are limited to the contribution made during the period. A plan is a defined benefit plan. So if the employer is unable to show that it has transferred all the risk, then it's a benefit plan. So the word unable is very important, that if the company is unable to show that it has transferred all the risks, then it's a defined benefit plan. Okay, so Usman is saying now this point makes sense. That's good, Usman. So now we are going to discuss the accounting for defined contribution plan. In contribution plan, company is liable to contribute. That's it. Liable to contribute. Once we have contributed, we have no risk. Once we have contributed, we have no risk. Now everything is between the employee and the fund. The company is not going to receive anything back. The company is not going to pay further anything. So once we have contributed, we are completed our we have completed our obligation. Now, what is the accounting? The accounting is that the contribution paid by the company should be recorded as an expense. The contribution paid by the company should be recorded as an expense. So if we have paid $10,000 of contribution, we are going to make an entry as bank credit and the expense debit by $10,000. But if we have any unpaid amount, it should be treated as a liability. So let's say we have paid only 8,000 out of the 10,000. We had to pay 10, but we have only paid 8. So what is going to be done? We are going to credit the bank by 8,000 and remaining 2,000 is a payable to us. It is a liability to us. So we are going to recognize the expense by 10,000, still same, although we have paid only 8 and the remaining 2 will be paid later on. So any unpaid amount should be treated as a liability. And any overpaid amount, if we have mistakenly paid, let's say $12,000 instead of 10. So we have overpaid an amount, it is treated as an asset. So the overpaid amount was 2,000, we should treat it as an asset and we should recognize the expense at the same amount of 10,000. So the 10,000 amount is the same in all three cases. But we are going to treat it as an asset only if it is expected to be recovered. If we are expecting to recover the additional amount paid, then it's an asset. Otherwise, it's an expense. Like for example, the company mistakenly overpaid an amount in 2006 for an employee. The employee got retirement in 2010 and the employee actually expired in 2015. And the company get to know in 2019 that we had an overpaid amount in 2006. Now the company has paid the amount to the employee. The employee has consumed the amount and has died so far. Now we got to know that we have an overpaid amount. So that's not an asset because we cannot recover that now. So if an amount cannot be recovered, it's an expense. If the amount can be recovered, it's an asset. If the amount cannot be recovered, it's an expense. If it can be recovered, it's an asset. So this is a simple accounting which you need to do. Unpaid liability, overpaid asset, contribution paid expense. So any confusion so far? Because next we are starting the accounting for the defined benefit plan. Any questions in this? Okay, so everyone is clear on this. Let's move next. So the next area we have an example. Let's quickly solve this. The contribution paid is recorded as an expense. So if there's an ABC Limited has a payroll cost of $5 million for the year ended 31st December 2015, the company has a defined contribution scheme. The question has already mentioned the scheme as contribution and pays pension of 5% of the salary cost each year. So out of 5 million, 5% is going to be 0.25 million is the amount which should be paid. During the year, ABC Limited paid 0.2 million and will pay over the remaining balance in January 2016. So now what entry are we going to make? We're going to make the expense at 0.25 million, but we have paid the amount by 0.2 million. So remaining 0.05 million is going to be the liability. Adil Said is saying, is there any standard format to solve pension related question in exam? Yes, Adil, there is a format for the defined benefit plan. There's a format for the defined benefit plan, which we're going to discuss the next. So this was an easy question. Now let's discuss the accounting for the defined benefit plan. Now what happens in defined benefit plan is that the employee remains in the employment and then there comes a date of retirement, after which period is called the post retirement. Now the employee is going to receive the benefits after retirement. That is why we call this a post retirement benefit, because the employee is going to receive the benefit after the retirement. But the question is that at what point of time should we recognize the expense? At what point of time should we recognize the expense? Should we recognize it after the retirement or should we recognize it before the retirement? At what point of time should we recognize the expense? Before retirement or after retirement? Krishna is saying before. Okay, Lamia is saying before. Sheroz is saying before. Mohammad Abli is saying after. Okay, basically, yes, the expense should be recorded during the time of employment. Why? Because of matching concept. Now in SBR, we need to link the framework, the concepts with the standards. In P2, we only used to learn the standards, but in SBR, we need to link the concepts with the standards, that according to the matching concept, we recognize the expense when we get the benefit in return. So we are going to get the benefit from the employee during his employment. So the expense should also be done, should also be recorded over the employee's employment term. So okay, so the expense of benefits paid should be recorded over the employment period. Like for example, if we ask the employee that if you work for the company for 20 years, you can take the retirement, and we're going to give you 10% of the last salary as a pension. We're going to give you 10% of the last salary as the pension until you are alive. Now, this is the benefit that we are going to give to the employee. So this benefit should be recorded as an expense over 20 years. This should be recorded as an expense over 20 years because we are getting the benefit from the employee in the 20 years. So we should be recognizing the expense over the same time. So the expense allocated to each year is called the current service cost. Now let's suppose that we are expecting a last salary of the employee of, let's say, $400,000 per annum. So 10% of that is going to be $40,000 per annum, which we are going to pay to the employee. And if the employee lives for, let's say, 20 years after the retirement, the employee is going to earn, let's not take 20, let's take 15. So the employee is going to earn approximately $600,000. The employee will earn $600,000 of the post-retirement benefit. Now this should be recorded as an expense over the 20 years. So which means every year's expense should be $30,000. This $30,000 is called the current service cost. This is called the current service cost, total expected amount to be paid divided by the number of years. Obviously, this is not the accurate calculation because we also need to calculate the present values of these. But this is just an idea of how the current service cost is going to be calculated. So we actually calculate the total expense to be paid divided by the number of years, and every year's cost is called the current service cost. And for this, we recognize an entry as the expense debit and the liability credit. And this liability is called defined benefit obligation. This liability is called defined benefit obligation. So we can say the entry is expense debit and the defined benefit obligation credit. Hafiz Nasir is saying, explain again. Hafiz, we actually took an assumption that we have an employee whose last salary is going to be 400,000 per annum, last salary at the time of retirement, and we are going to give 10% pension of this, which is going to be 40,000 per annum, And if we are estimating that he lives 15 years after the retirement, we're going to pay him $600,000 in total. Now, this $600,000 cost should be recognized as an expense over the 20 years. This should be recognized as an expense over 20 years. So we are dividing that over 20 to get the annual expense of 30,000, which is known as current service cost. Okay, most welcome, Hafiz. Now, the second thing is that the all values should be recorded in present value terms, because the time value of money today after 20 years and after 35 years is going to be different. So we should be recognizing everything in present value terms, and anything which is calculated in present value terms is actually is actually increased, unwinded every year. So the entry for unwinding is going to be again expense debit and the DBO credit. So all liabilities which are calculated at present value are actually unwinded or unwound every year. Unwinded or unwound means increasing back the liability every year. And at the end of each year, the estimates will be reassessed. At the end of year, we are going to recheck that is our previous estimates the same or have they changed. And the liability will be recorded as per the new estimate. Like let's suppose that after the year end, we actually, or after 2 years, which means the liability of 60,000 was recorded. After 2 years, our estimate got changed and we think that the employee is not going to earn 400, is going to earn 500,000 last salary, annual salary, and 10% of which is going to be $50,000 of the pension. And we think that he's going to live for the same 15 years, which means he's going to earn $750,000 in total. And if he's going to earn 750 in total, this should be divided over 20 years. So every year's expense should be 37,500. And for 2 years, the liability should be $75,000. According to the new estimate, we have reassessed the liability and rechecked after 2 years. So we have got a new estimate of 75. Yes, Roshan, it's a new estimate as per IS 8. Now we have recorded the liability of 60, which should be increased to how much? To 75,000. This difference of 15,000 is actually called the remeasurement gain or loss. This is called the remeasurement gain or loss, or the remeasurement component, or we also call this an actuarial gain or loss. This remeasurement gain or loss or the actuarial gain or loss is going to be recognized in the OCI, in the other comprehensive income. Because in this case, if we are estimating the last salary and the life of an employee after 20 years, obviously this is going to be a vague estimate. This is going to be a vague estimate. Can you tell what is going to be your salary after 20 years? Obviously not. That will be a very vague estimate. And how much you're going to live after the retirement? Can you estimate that? Obviously not. That's a very vague estimate. So because the estimate is very vague, we do not take it to the P&L. Rather, we take it to the OCI, other comprehensive income. So if the liability is increasing, we are going to debit the OCI, we are going to credit the DBO. So what we are doing, we are actually reassessing the liability at the year end with any change taken to the OCI prospectively. Is it clear so far how we are going to account for the liability? We are recognizing the expense over 20 years because the employee has to work for 20 years. We are calculating everything in present value terms and then unwinding every year. And then we are going to reassess the liability with changes taken to OCI. Everyone clear so far? You're just saying yes. So, okay, good. Now, the next thing that we need to discuss is that If you remember, the company was transferring a contribution to the fund, and the fund was actually investing it and then getting the and then getting the return. Now, if the risk and rewards of the fund belongs to the company, if the risk and rewards of the fund belongs to the company, this means the fund is an asset for the company because the asset belongs to the party who bears the risk and reward. So in this case, we are also going to recognize the fund as an asset. We are also going to recognize the fund as an asset for the company. So the first thing in this is that fund will be treated as an asset for the company as the risk and rewards belongs to the company. Fund will be treated as an asset for the company because the risk and rewards belongs to the company. Second thing is that the interest earned by the fund or the return earned by the fund will be an income for the company because that is what the fund is earning for the company, not for the employee this time. The fund is earning for the company this time because the company is liable to pay benefit to the employee. And the fund is not liable actually, the company is liable. And the contribution into the fund will increase the value of the fund. So we can say that if we are paying a contribution, we are crediting our bank and we are debiting the fund, which is also known as the plan asset. So the entry is going to be bank credit and the plan asset debit. Similarly, for the interest income, the entry is going to be the plan asset debit and the interest income, the P&L credit. So the interest earned by the fund is a return for the company, and the contribution paid will also increase the fund. The last thing is that the benefits will be paid from the fund, which is going to decrease the fund. When the employee retires, the fund is going to pay the amount on behalf of the company to the employee. And the entry for this is going to be DBO debit because if we pay the benefit to the employee, our liability is going to be reduced. And the plan asset credit. So we are going to credit the plan asset and we are going to debit the DBO because our liability is reducing as well as the plan asset is reducing. So this is how we are going to do the accounting for the plan asset and the liability. Now, if we make a format of this discussion within so let's solve an example where we have a present value of the defined benefit obligation at the start of the year, which was 210. At the year end, this was 378. Okay, so the liability opening was 210, the liability closing was 378, The fair value of the plan asset opening was 168. The fair value of plan asset closing was 294. The current service cost was 63. Contribution paid was 105. Benefits paid was 20 million and the discount rate is 10%. So now we are going to solve an example with all of these values, and in the question you are going to receive all of these values, and we just have to solve the accounting treatment of this because these values are professionally calculated by an actuary. These values are professionally calculated by an actuary. So the calculation of these values is not a part of the accountant's work. So now we have a table where we have brought forward, we have interest expense or income, we have the current service cost, the contribution paid, the benefits paid, remeasurement gain or loss, and the carried forward. So if I go back to the question, I have a liability value of 210 and 378. So I'm writing in my table 210, 378. The plan asset is 168 and 294. So 168 and 294. So now these four values have been incorporated. Then we have contribution paid of 63 and benefits paid of 105. So contribution paid was 105, which is going to increase the plan asset, and the service cost is going to increase the liability because the entry of 63 is expense debit and the DBO credit by 63. And the entry for 105 is the plan asset debit and the bank credit by 105. But obviously we do not need to think the entry for every single value. We are going to make an entry for all of the values at the end. But it's just that I'm telling you so that you people can better understand these things. So 63 current service cost, 105 contribution paid, and then we had benefits paid of 20 million and interest rate of 10%. So we are going to use 10% over here, and benefits paid will reduce both the liability and the asset. So the entry for this is going to be DBO debit and the plan asset credit by 20. So this is how we have incorporated the current service cost, the contribution paid, and the benefits paid. Now, when we talk about the interest is going to be 10% of 210 and 10% of 168, which is going to be 21 and 16.8. Now we have everything other than the remeasurement gain or loss. So now let's calculate that, which is going to be the balancing figure. So let me use a calculator for this. So it's going to be 210 plus 21 plus 63 minus 20, which is going to be 274, and this should be increased to 378, which means there's a balancing figure of 104. So 104 is a positive value in this. 104 is a positive value in this. So we have calculated the sum. We have got the difference with 378 and written in the remeasurement gain or loss. Is this a gain or a loss? Positive 104. Is this a gain or a loss? Positive 104. Is this a gain or a loss? Okay, Krishna is saying loss, Mohammad Amil is saying gain, Shahzad is saying loss, loss, gain, loss, gain, gain, loss, gain. Okay, so now let's understand a lot of loss at the end. This is a loss. This is a loss. Why? Because 104 is actually an increase in liability. We are increasing the liability from 274 to 378. We are increasing the liability from 274 to 378. So increase in liability is actually a loss. So that is why we are going to call 104 a loss. So this is a remeasurement loss for us. Now similarly, if we calculate a balancing figure on the asset 2, we have 168 plus 16.8 plus 105 minus 20, which is going to be 269.8. So this should also be increased to 294 by 24.2. Now this 24.2 is also a positive value. We are increasing the plan asset too. Now is this 24.2 a gain or a loss? Okay, Roshan is saying loss, Shahzad is saying gain, Christopher gain, gain, and everyone is saying gain. So yes, this is a gain because this time we are increasing the plan asset. This time we are increasing the plan asset. So increase in plan asset is a gain. Increase in DBO is a loss. Increase in plan asset is a gain. Increase in DBO is a loss. So 104 was a loss, but 24.2 is a gain. Now we need to calculate the net liability, which is DBO minus the plan asset. This is going to be DBO minus the plan asset. So 210 minus 168 is going to be 42. 21 minus 16.8 is going to be 4.2. 63 minus 0 is going to be 63. 0 minus 105 is going to be minus 105. And this is benefits paid is going to be how much? Negative 40 or 0? Benefits paid should be how much? Negative 40 or 0? Hamza Naeem is saying 0. Farida is saying 0, 0, 0. Yes, it's a 0. Christopher is saying negative 40. It's a 0. Why? Because actually DBO was minus 20 and minus 20 of plan asset. So this will become minus 20 plus 20, which is a 0. So the value in the benefits paid will always be 0. Then we have 104 minus 24.2, which is going to be, let's use a calculator, 104 minus 24.2 is going to be 79.8. And at the end, 378 minus 294 is going to be 84. Let's recheck using a calculator. 378 minus 294 is 84. Yes. So this is how we have prepared the table. And now if I prepare a single entry for all of these values rather than making a lot of small entries, we're going to say that the interest cost and the current service cost should be taken to the P&L. The interest cost and the current service cost should be taken to the P&L, and the remeasurement gain or loss should be taken to the OCI. The amount paid from the bank should be credited from the bank, and the liability, which was 42, has increased to 84. This should be taken to the non-current liability. So if I make a single entry for all of these, I'm going to say P&L debit by 67.2, P&L debit by 67.2, OCI debit by 79.8, bank credit by the amount of 105, and the non-current liability credit by 42. Why 42? Because the carried down was 84 minus the brought down was 42, so the liability is increasing by 42. Okay, Shahzad Ali is saying that the screen is not moving. Is it moving now? Can you see the updated screen? Yes. So this is how we have made an entry of P&L debit, OCI debit, bank credit, and the non-current liability credit. So any confusion in this? Have you people got this? The liability has increased from 42 to 84. The amount of P&L as the interest and the current service cost. The contribution paid is paid from the bank. The remeasurement gain or loss is taken to OCI. And now if we post all of these values in the next slide, these are the notes to the profit and loss account. And this is the note to the OCI, and this is the note to the statement of financial position. So this slide is basically showing the disclosures of IAS 19. So we are going to write the interest cost and the service cost component. The interest cost was 4.2, and let's check the service cost. It was 63. So in total, this is the 67.2 taken to the P&L. In the balance sheet, we have a liability of 378, asset of 294. So we are going to say 378 minus 294. So the net asset is of 84. The net asset is of 84. This 84 is going to be taken to the statement of financial position. This is going to be taken to the P&L. And in the OCI, we're going to show the remeasurement, gain or loss. We had a loss in the DBO and we had a gain in the plan asset. So what was the amount? The amount was 104 and 24.2. So loss of 104 and a gain of 24.2 is going to result in a net value of how much? 79.8. Let's check using the calculator. 104 minus 24.2 is 79.8. Yes. So this is how we have prepared the table. We have prepared the entry and we have prepared the disclosures. Any confusion in this? Any confusion so far? Okay, just give me 2 minutes and then we're going to continue. Just give me 2 minutes. Okay, so Laura is saying, could you go back to the question slide? Okay. So this was the question slide. You can take the snapshot. Okay. Ole Jukumuke. A very difficult name. I cannot pronounce that. How did you get the remeasurement on plan asset? Basically, it's the balancing figure. Let me recalculate for you. Shehzad is saying, sir, as DBO is greater than the plan asset, why is not a net liability? It's a net liability, Shehzad. It's a net liability. Have you taken the screenshot, Laura? Okay, so the remeasurement gain or loss, this 24.2 is basically the balancing figure. Let me use the calculator again. I have added 168 plus the 16.8 plus 105 minus 20. So 269.8 was the total of these values. And then I deducted 294 to check the balancing figure, which was 24.2. Getting this point O, I'm calling you O because I cannot pronounce your name. It's very difficult. So this is 24.2, how we have got that. Now for Shehzad, yes, Shehzad, this is a net liability. This is a net liability actually of 84. So this is going to be taken to the balance sheet. And that is why over here we have said it to be a net liability. The net liability was 42, which has increased to 84. That is why we have credited the non-current liability. Eniola is asking to be added to the WhatsApp group. Eniola, can you please message me personally on the WhatsApp? I'm going to send you a link and then you are going to be added onto that. Because after the session, it will be very difficult to identify people who have sent their names in the chat box. So it's better to contact me personally. I'm going to send it. Okay, so now the next thing we are going to discuss is going to be the past service cost. Past service cost. What is a past service cost? Now let's suppose that we had promised to the employees that we are going to give them 10% of their last salary as a pension until they are alive. We are going to give 10% of the last salary until they are alive. This is the benefit that we are going to pay to them. Now what happens that we were expecting the last salary of 400,000 of an employee and 10% we were planning the pension of 40,000 and we were expecting the employee to live for 15 years. So we were expecting an amount of 600 which we had divided over 20 years and we were recognizing expense of 13. Do you remember this example? This was there in the previous slides. So we were recognizing an expense of $30,000 every year. Let's suppose after 5 years, when the liability was recorded as 150,000, after 5 years, what happened? We called all of the employees and we said that we are going to pay 20% of the last salary as a pension. We have actually changed the plan and we say to the employees that we are not going to give you 10%, we are going to give you 20% of the last salary. Now, what will happen if we have changed the percentage? Our liability should also change because now we are liable for 20% of the last salary, which makes it 80,000. And if the employee lives for 15 years, this is going to make it 1200,000, which is 1.2 million. And if we divide it over 20 years, our annual expense should have been 60,000. And in 5 years, the liability should have been 300,000. So this change in the plan will increase our liability by 150,000. This change in the plan will increase our liability by $150,000. This 150, the change in liability is called the past service cost. This change in liability is actually called the past service cost. So past service cost is the change in liability due to change in pension entitlement. This is a change in liability due to a change in pension entitlement. If we change the plan, the liability should also change, and that is called the past service cost. Getting this point? So the past service cost may either be positive or maybe negative. Positive means where we increase the benefit of the employees, and negative means where we reduce the benefit of the employees. So if we are increasing the benefit, it's a positive past service cost. If we are reducing the benefit, it's a negative past service cost. So the past service cost may be positive or it may be negative. So we need to write one more point in this, that all past service costs are recognized in P&L immediately. All past service costs, whether positive or negative, are going to be recognized in the P&L immediately. So in P&L, it is also going to be a part of service cost component. It is also a part of service cost component. Is it clear to everyone? Okay, Roshan is saying why is it called past service? Roshan, because we are recognizing this 150,000 which actually relates to the 5 years which have already passed by. We have calculated the amount over 5 years which is already have been passed by. These relates to the employee's past service, past 5 years. 5 years already spent. Getting this point, Roshan? Because this cost relates to the past service, previous 5 years, that is why it is called a past service cost. Okay, O is saying what's the difference between 15 and 20 years used? Basically, O, sorry, I'm calling you O, because we were expecting the last salary, the life of the employee as 15 years. We are expecting the employee to live 15 years after the retirement. That is why we have multiplied it by 50 years. And now this is the total benefit we are going to give to the employee. And this total benefit should be expensed out over the 20 year, which is the employment period. If the employee works for 20 years, only then he's going to get the pension. So this is the employment period of the employee. Getting this point, everyone? Okay, so now let's move next and discuss about the curtailment. We will be taking a break at 9 p.m. Pakistan time, and then we'll be continuing after 15 minutes. But not right now at 9 p.m. Okay, Godfrey is saying is then prospectively. Yes, Godfrey, because it's a change in accounting estimate. It's a change in accounting estimate. It's a company policy, but for accounting, it's an estimate. So that is why we are doing this prospectively. Okay, so now what if we decrease the number of employees in the plan? Like for example, we had 10,000 employees in the plan to whom we are promising a defined benefit plan. But later on, we change the plan and we say, okay, let's remove 2,000 employees and give this plan to 8,000 only. So now 2,000 employees have been decreased from the plan. So we say that this decrease is either going to be a substantial decrease or is not going to be a substantial decrease. If the decrease is not substantial, we are going to call this a past service cost. If the decrease is not substantial, we are removing 2 employees, 5 employees, 10 employees, 1 employee. So this decrease in the plan is not substantial, it's not material. So we call this a past service cost. Now this substantial has no specific definition. This substantial cannot be given a number. This depends on the company to company. A company who is promising only 2 employees, and if one is removed, that will become substantial. But if a company has 10,000 employees, and even if it removes 10 of them, that's not substantial. So the word substantial is basically subjective. We cannot give it a specific value. Godfrey is saying, what the essence for pay the employee, the difference in the past service cost. Basically, yes, Godfrey, the company should not pay an additional benefit for the past service, but the company may pay actually to gain the employee's loyalty, to increase the employee's confidence, to increase his job security. So so actually these are the points which actually motivates the people. Like like why does a company give bonus to someone? To increase the loyalty, to increase his efforts, so that the employee works well next time too. So if a company is giving a benefit relating to the past service, then we're going to recognize that as an expense. So now if the decrease in the employees is not substantial, it's a past service cost. And if the decrease is substantial, we are going to call this a curtailment. If the decrease is substantial, if it's material, we're going to call this curtailment. Now, what is the accounting of curtailment? The curtailment is going to be either with settlement or without settlement. Either the curtailment is going to be with settlement or without settlement. So if we are removing the employees from the plan, we may pay them cash in return, or we may not pay any cash. So if we are not paying any cash, we are not paying any cash. So this is a curtailment removal without settlement. So we are going to debit our DBO. DBO means the liability. So we are going to debit the DBO and we are going to credit the gain in the P&L because our liability has reduced and we haven't paid anything. So this is a gain to us. But if we are paying an amount, either we may overpay or we may underpay, or we may even pay the exact amount. So the entry should be for which settlement the entry should be the plan asset credit, because we are not paying the amount ourselves. The amount is going to be paid from the fund and our liability is going to be reduced. So the entry should be DBO debit and the plan asset credit with the balancing figure, if any, taken to P&L. Because if we are paying an amount, the plan asset will be reduced, and as we have completed the promise, the liability is going to be reduced as well. So plan asset credit, DBO debit, and the balancing figure, which represents any overpayment or any underpayment, if any, that is going to be taken to the P&L as a gain or as a loss. So in both the cases, we are debiting the DBO. In both the cases, we are crediting the plan asset. But if we are underpaying, we are going to have a gain on the credit side. If we are overpaying, we are going to have a loss on the debit side. So this is how we are going to incorporate the curtailment, settlement, and the past service cost. Okay, Godfrey is saying, why do we expense them hence in future expense? Basically, Godfrey, this is a change in accounting estimate. And all change in accounting estimates basically impair the matching concept because it relates to the previous years, but we cannot edit the previous years because this is a change in estimate. So you are right that this should not be recorded in the future, it should be recorded in the past. But as this is a change in estimate, we cannot go back and change the financials of the previous years. Okay, it's good. Got this point. Now the next area is another example. This is example 2 actually, not 1. So we have an opening liability, we have a closing liability, we have an opening plan asset, we have a closing plan asset, we have some current service cost, we have some past service cost, and we have the amount of contribution, and we have some benefits paid on 1st January. Then we have curtailment and settlement and the discount rate. And then there's a table. Can you people try solving the table on your own for a while? Invest some time, take 2 to 3 minutes and solve this. So you have 2 to 3 minutes to solve this question quickly, and then I'm going to solve with you. So try not to invest too much time, so that we can invest the time on more understanding. Shahzad is asking when will the session end. Shahzad, we are going to end at 11 p.m. Pakistan time, 11 p.m. You people have last 1 minute, quickly complete the question, and then I'm going to solve it. Okay, so let's solve this. We have a liability opening of 210, closing 378. So it's 210, 378. Plan asset is 168, 294. And then we have current service cost 63, past service cost 21. Both of these are going to affect the DB only. Krishna has a remeasurement loss of 53.8. Okay, let's see. So the contribution is 105, benefits paid are 20. Contribution 105, benefits paid 20. And then we have a curtailment of 5, settlement of 6. So there's going to be a loss. Curtailment of 5, settlement of 6. So we have overpaid. It's a loss of 1, which will increase the liability. The curtailment was of 5, the liability was of 5, but we have paid 6. So this means there's a loss of 1, which will increase the liability. And at the end, we have a discount rate of 10%. So we are going to apply this. But when we are applying the discount factor, there's one more thing which is very important: the dates. If we see, the past service cost has a date of 1st January, this one. Similarly, the benefits paid also have a date of 1st January. Now, both of these two things were at the start of the year. So if the liability opening was 210, the liability would have increased by 21 on the first day of the year and decreased by 20 because of the benefits paid on the same date. So in actual, the liability that we are going to unwind should not be 210, rather this should be 211. So 10% of this is going to be the interest cost of 21.1. So first we need to adjust the values which are given at the start of the year, and then we are going to unwind it to calculate the actual finance cost. So 21.1 is going to be the interest expense. Are you people getting this? That we have first adjusted these values in the brought down. Similarly, the plan asset was also 168 at the start, but the plan asset will not be affected. By the past service cost, but will be affected by the benefits paid. So this means that the adjusted plan asset is 148, and 10% of this is going to be 14.8. So first we are going to adjust the brought down balances and then calculate the interest. Godfrey is saying why we unwind the costs. Basically, Godfrey, what happens is when we calculate the present value, like let's suppose I'm explaining just from a basic example. If I have to pay $13.31 million after 3 years, and I want to calculate the present value today using a 10% discount rate, it is going to be 10. So this means I've recorded a liability at 10, but I have to pay 13.31. So what I do is I'm going to increase the liability every year by same 10%, which will make the liability to 11. And then I'm going to increase it again by 10%, which will make it 12.1 in the next year. And then I will increase it again by 10%, which will bring it back to same 13.31 million at the end of year 3. So this is called present value discounting, bringing the value of 13.31 to 10, and then increasing it back is called the unwinding, compounding. So whenever we record a liability at its present value, we need to unwind it so that the liability can be brought back to the original value which needs to be paid. If we are not calculating the unwinding, we are not measuring the liability at its right value. Are you getting it, Godfrey? That what exactly is unwinding? So now the opening liability was 210 and then the past service cost is also given on the same date. So this means both should be unwinded. We should unwind 210 plus we should also unwind 21. So we have added it in the brought down before unwinding. And on the same date, we have paid an amount. So this has reduced our liability at the start. So when the liability has been paid by 20, why should we unwind that? So we added 21, we deducted 20, and then we calculated the unwinding. Getting this point, Godfrey? So now 21.1 and 14.8 are the right values. Okay, it's good. You have got it. Now we are going to calculate the balancing figure. So this is going to be 210 plus 21.1 plus 63 plus 21 minus 5 minus 20, which is going to be 290.1. So we need to increase the liability by 87.9. So this is the amount of remeasurement gain or loss. This is positive. This means this is a loss. And for plan asset 168 plus 14.8 minus 6 plus 105 minus 20 is going to be 261.8. So this should also be increased by 32.2. So this 32.2 is a gain. So now 210 minus 168 is going to be 42. And then 21.1 minus 14.8 is going to be 6.3. Then we have 63, 21, 1, negative 105, 0. And then we have 55.7. And the total is going to be 84. So this is how we have completed the table. Now when we are going to recognize the values in P&L, all of these values will be taken to the P&L. The interest cost, the current service cost, the past service cost, and the curtailment and settlement. Godfrey saying, sir, is it possible to get the video lecture after the end of today's session? Godfrey, I think the admin needs to reply on this point because tomorrow is Sunday. So I think today's session will be updated on Monday. I'm not sure. The admin may be replying to this in a better way. And 55.7 is going to be taken to the OCI. 105 is paid from the bank, and the liability has increased from 42 to 84. So if I prepare an entry, I'm going to say P&L debit by the sum of all these values, 63 plus 6.3 plus 21 plus 1, which is 91.3. So 91.3 in P&L, 55.7 in OCI, payment of 105, and the non-current liability increased by 42. Usman is saying, can you please give journal entry of these? Usman, all of these, if you want entries for all of these, we can simply say, for all this, we are going to debit the expense, P&L, and we are going to credit the DBO, except for one. For one, we are going to credit the plan asset by 6, debit the DBO by 5, and debit the P&L by 1. The remaining entries you are already aware. Okay, Usman was talking about this entry. So now let's make the disclosures. The interest cost was 6.3, current service cost was 63.21, and the loss on settlement was 1, and the sum of all these was how much? 91.3. So in disclosure, we are just providing the breakup. DBO was 378, plan asset was 294. So we have a net liability of 84. It's a net liability. And then in DBO, we have a loss of 87.9 and a gain of 32.2. So it's a loss and this a gain. So we're going to deduct this and the total is going to be 55.7. So in disclosures, we are simply providing the breakup, nothing more. So now we are moving towards the past papers where we have a question by the name of Kuchin. Let's solve this. In the question, the question says in the requirement, discuss which suitable workings. So the main focus is on discussion, but we also need to provide the workings. How the pension scheme, pension means employee benefits, post-retirement benefits, should be dealt with after the restructuring of the business segment. And means the question needs to be breakdown from over here. So this is the first part of the requirement. And now we need to answer the second part of the requirement, which says whether a provision for restructuring should have been made in the financial statements for the year ended 31st December 2006. So the question has asked us two things: how we are going to deal the pension scheme and whether a provision should be recorded or not. So these are two parts of the question. Now let's read it out. Cochin has decided to restructure one of its business segments. The plan was agreed by the board of directors on 1st October 2006 and affects employees in two locations. In the first location, half of the factory units have been closed. By 31st December 2006, which is our year end, so we have already closed these factories, and the affected employees' pension benefits have been frozen. This means that we are not going to pay the pension benefit to anyone. This means this is a case of curtailment because the half of the factory units have been closed, so the employees would be substantial, and we have frozen their benefits, which means we are not going to pay any benefit now. So this is a case of curtailment. Any new employee will not be eligible to join the defined benefit plan. So there are no more people joining this. After the restructuring, the present value of defined benefit obligation in this location was 8 million. So after curtailment, we have a liability of 8. The following table relates to location 1, where the question has given us the value before restructuring, and the present value of DBO was actually 10, which has reduced to 8. The value was 10, which has reduced to 8. So this means that the entry should be DBO debit by 2 million and again credit by 2 million. DBO debit by 2 million and again credit by 2 million, because we have frozen the benefits, we are not going to pay anything. In the second location, all activities have been discontinued. We have discontinued all the activities. It has been agreed that employees will receive a payment of $4 million in exchange for their pension liability. Of 2.4 million in the unfunded pension scheme means there's no fund, so the company will pay from its own bank account. So in the second location, the liability was how much? The DBO was 2.4 million, but we are going to pay them 4 million. We are going to pay or we have paid? We will pay. Employee will receive. So this means it's payable yet. So DBO debit by 4 million, payable credit by 1.4 million, and the balancing figure should be taken to the P&L by 1.6 million. So this is how the location 1 and location 2 was to be dealt in the in the question of Kuchin. Okay, I have written something wrong. Yes, there's something wrong actually. Let me correct that. Will receive a payment of 4 means the payable is of 4. The liability was of 2.4. So there is a loss of 1.6. I have actually mistakenly changed the values. Thank you, Usman, for reminding. So we had a liability of 2.4. We will pay 4. So the loss should be 1.6. Now the question further says that Kuchin estimates that the cost of the above restructuring excluding pension cost will be 6 million. So now the question is talking about provision for restructuring, which is IS 37. So do you people remember the criteria for recognizing a provision in IS 37? Do you people remember the criteria for recognizing a provision in IS 37? Yes. So what were the criteria? What were the criteria for recognizing a provision? Usman, you are telling the general points of provision. Right now, we are talking about provision for restructuring. Provision for restructuring have two criteria. Formal plan, detailed formal plan is prepared and approved. This is the first point. It should be prepared and approved. And the second should be, it should be announced to the affected parties. So there are two criteria of IAS 37. First being that the detailed formal plan should be prepared and approved. And the second criteria is that it should be announced to affected parties or their representatives. So yes, a lot of people are giving the right answer. Now the question says that Kuchin has not accounted for the effect of the restructuring in its financial statements because it is planning a right issue and does not wish to depress the share price. So Kuchin has not recorded anything because he does not want to depress the share price. Therefore, there has been no formal announcement of the restructuring. There is no formal announcement of the restructuring. So should we prepare a provision or not? Should we prepare a provision or not? Okay, Ghania is saying yes, Krishna is saying no, Shadad is saying no, Usman is saying no, Laura is saying yes, Corina is saying yes, Godfrey is saying no, no, no. Okay. The correct answer is yes, we should be preparing the provision. Why? Because the first criteria was met over here that the plan was agreed by the board on 1st October 2026. So the board has already approved the um, the plan for restructuring. Second thing is that half of the factory units have been closed. Half of the factory units have been closed and the employees are not informed. Is this possible? Half of the units have been closed and the employees are not informed. Is this possible? Obviously not. Secondly, all activities in the second location have been discontinued. And even we have agreed that we are going to pay 4 million instead of 2.4 million, but we haven't announced to the employees. Is it possible? Obviously not. This means that the employees are already informed, but the question is talking about an announcement to the shareholder over here, because it has said that it's planning a right issue and does not wish to depress the share price. So this announcement is something relating to the share price, which means announcing to the shareholder. And announcing to the shareholder is not required. The criteria says announce to the affected parties, and the affected parties in this is the employee. So if the employees are informed, the criteria has met. If the employees are informed, the criteria are already met. So that is why we are going to recognize the provision in this case. Are you people getting this point? Hiba is right. She's saying that the announcement is deliberately not announced. Exactly. So the company is deliberately not announcing so that it can increase the share price till the issuance of right issue. Okay, so now the next thing we are going to do is to write down the answer. This is also something which is very important. So if we try to write it down, I'm going to say that as per IES 19, um, in case where there's a decrease in the number of employees, or we can say if there is a substantial decrease in the number of employees in the post-retirement plan, it is treated as a case of curtailment, where the defined benefit obligation is reduced by the decrease in liability, and the fund is decreased by the amount paid from the fund, and any overpayment or underpayment is recognized as a gain or loss in profit and loss account. So this is a general part of the answer. So normally in exam, what you need to write a general paragraph, or we can say basically the rules that we are going to apply, and then we are going to apply this onto the scenario, and based on the application we are going to draw a conclusion. So these are three things that we need to write down: the rules, the application, the conclusion. So now we have written the rule that what are the rules for curtailment. Now we are writing the application, that in case of Cochin, half of the factory units have been closed in location 1, and all activities have been discontinued in location 2. Therefore, the decrease in employees is substantial. So the first thing that we are writing is actually applying that it's a case of curtailment. Therefore, the treatment of curtailment should apply. Now the next thing that we are going to write down is basically about the location 1. In location 1, the curtailment is without settlement. Therefore, the liability should be reduced by $2 million, which is the difference between 10 million and 8 million, with the same amount being recorded as a gain. In location 2, the curtailment of 2.4 million dollars will be settled by Kuchin, with $4 million being paid to employees. Therefore, Kuchin should not. Now, if you see, we are writing the application as well as the conclusion both together, because I have applied onto case 1 and concluded together. Now I'm applying on case 2 and concluding together. So therefore, Kuchin should reduce its non-current liability by $2.4 million and instead recognize a current liability by $4 million, with the loss of $1.6 million being recognized in P&L. With respect to the provision for restructuring, Cochin has made the detailed formal plan and has even executed it. Therefore, the provision should be recorded by $6 million as the criteria are met. The announcement which has not been done or made seems to be an announcement to the shareholders, as Cochin does not want to depress the share price. However, as the factories and activities have been discontinued, the employees would be well informed. Therefore, a provision of $6 million should be made. So this is how we have actually written the answer, starting with the basic IAS 19, applying onto the first case, and then applying onto the location 2, and then writing down about the, sorry, and then writing down about the provision. So this was the first question that we have solved. If you people have any problem, you can ask. I will be sharing these answers on the WhatsApp group too. So let me even copy this to a Word file so that I can actually share with you people. Okay, so any questions so far? I hope you are getting how to write down the answer in the exam, because this is also very important that that you should be understanding the topic, you should be able to understand the question, and you should be able to communicate it properly to the examiner. Are you people clear so far? Okay, so now let's take a break. for 10 to 15 minutes, and then we are going to continue after break. So you can have some tea, coffee, have some rest, drink water, go for a walk, so that you are so that you come back active, and then we're going to continue with the session, and we're going to end at 11 p.m. Pakistan time. So it's right now 9:09 or 9:10. Let's continue in a while. Iraj, we are going to cover 19 and then we are going to start IFRS 2. So most probably I'm targeting that at 10 we complete 19 and at 10 we start the IFRS 2. Okay, everyone, welcome back. And now let's continue with the presentation. We have solved the first past paper question by the name of Kuchin. And now we have another past paper which is of June 2018 attempt, which is previous June. The question says that bread operates a defined benefit scheme. So the question has already informed us that it is a benefit scheme, which at 31st December 2016 was in deficit by $120 million, which means it was a net liability of $120 million, which means it is a net liability of $120 million. Details for the current year are as follows. So we have a current service cost of 55. We have a cash contribution to the scheme of 100. Benefits paid in the year of 80. Net loss on curtailment is 11. Gain on remeasurement is 9. So if we see, the question has not given us the breakdown of the asset and the liabilities, rather it has only given us a net liability of 120. So now the table we are going to prepare is of the net liability only. Like for example, if I write down the brought down, I'm going to say that the brought down of DBO and plan asset, we do not have the breakdown, but we can directly write it in the net liability of 120. The rate of interest applicable to good quality corporate bonds was 5%. So the interest is going to be calculated at the 5% rate. So it should be 5% of 120 ideally. And if we see there's no date given at the start of the year, so 5% of 120 is going to be how much? 6. Then we are going to write the current service cost of 55. And then we are going to write the contribution which is added in the plan asset and deducted from the net liability, this 100. And then the benefits paid will always be 0 in the net liability because it is going to be deducted from the DBO, deducted from the plan asset. So the net impact is going to be 0. And then we have a remeasurement. What gain? Gain means it is going to reduce the net liability by 9. So we have included 80, we have included 9, and then we have a remeasure curtailment loss. So loss is going to be added in the net liability by 11. Now the question says that the cash contribution has been correctly accounted for in the financial statements for the year ended 31st December 2007. This is the only adjustment which has been made in respect of the scheme. So we can calculate the total now. If I use the calculator, I'm going to say 120 plus 6 plus 55 minus 100 minus 9 plus 11. So the carried down is going to be $83 million. So the entry should be P&L debit, in which 6 interest, 55 current service cost, 11 is the loss on curtailment. So this is going to be 72. And in the OCI, we're going to record a gain of 9, and the bank should be credited by the amount of 100, and the remaining movement is of liability, which is reduced by 37. So this is how the entry should have been made. This is the correct entry, not the correcting one. So in P2 we used to make the correcting entries, but in SBR we need to focus more on the theoretical aspect rather than the correcting entries. But in case of consolidation, the question may still ask the correcting entries in SBR2. So if we write down the answer, we're going to say that in case of IES 19, or in case of post retirement benefits, IES 19, requires the entity the audio is too low. SM Ronukul. Is everyone else able to hear me properly? So in case of post-retirement benefit, everyone is saying yes. Ronukul, you need to check the audio from your side. So in case of IAS 19, requires the entity to recognize the interest cost, or we can say the net interest cost, current service cost, and the loss on curtailment in the profit and loss account. While the remeasurement gain or loss being taken to OCI. In case of bread, the total amount to be recognized in profit and loss account should be how much? Should be 72. With a gain of $9 million being recognized in OCI. Roshan is saying more marks will be on calculation or written parts. Roshan, more marks will be on written parts. The theoretical part will always be of more marks as compared to the calculation area. Okay, so this is how we actually had to answer this question. Christopher is saying, do we have to specify the IES number when answering these kind of questions? Christopher, it is not necessary to write down the IES number, but if you remember, it's better to write. Not compulsory, but it's better to write. Okay, so now we have another question by the name of Diamond. This is June 2017. So we are doing June 17, June 18, and maybe you're going to solve some IES 19 in June 19. So the question says that Diamond operates a defined benefit pension scheme. On 31st March 2017, the company announced that it was to close down a business division, something similar to the restructuring, and agreed to pay each of its 150 staff a cash payment of $50,000 to compensate them for the loss of pension. So we are actually paying this amount instead as a compensation of the pension. So 50,000 will be paid to 150 employees. So if we calculate it, it is going to be so it is going to be 50,000. 50,000 into 150 employees, which is going to be how much? 50 into 150 is going to be 7,500, 10.5 million, yes. So $7.5 million. It is estimated that the closure will reduce the present value of the pension obligation by 5.8. So we are going to debit the DBO by 5.8 and we're going to credit a payable of 7.5. So this will result in a loss which is to be taken to P&L. Diamond is unsure of how to deal with the settlement and curtailment and has not yet recorded anything within its financial statement. So the accounting is pretty simple. We just need to take the balancing figure to the P&L, which is going to be 1.7 probably. So let me write down the theoretical part of the answer too. And now we're going to talk about the curtailment and settlement. That in case where an entity reduces the employees from a pension plan or the pension scheme, if the number of employees are substantial, it is treated as a curtailment. Where the defined benefit obligation is reduced by the amount of curtailment and instead a current liability is recorded if the amount is yet to be paid. The difference of both the liabilities is recorded in the profit and loss account. In case of diamond, it should reduce the defined benefit obligation by $5.8 million and instead recognize a payable of $7.5 million with a loss of $1.7 million being recognized in profit and loss account. So this is your complete answer which should be written in this case. Any confusions in this? Okay, so now let's solve another question. This is by the name of Zippy. In fact, you can try this in the homework. And if you have any question, you can ask me on the WhatsApp group. This is one of the easy questions similar to the one we have previously solved. Only one thing which is different in this is that we have two different discount rates in this question. One is the opening rate and one is the closing rate. So if the question has given us both the rates, which rate should we use, the opening one or the closing one? If both the rates are given, should we use opening rate or the closing one? Corina is saying opening, Usman is saying closing, Hiba is saying closing, Edzaz saying, can you please show the agenda of the session? Okay, Edzaz, we are solving 19. Next, we are going to solve IFRS 2. The remaining agenda you can see in the recordings available tomorrow. Nabil is saying opening. Basically, yes, the rate should be used is the opening one. To calculate the interest expense, we should be using the opening rate. Because interest is calculated as for the year. So the rate which is going to apply during the year is going to be the opening one. The liability is calculated at the closing one. But the interest expense or the interest income is calculated at the opening rate. The interest expense or the interest income is calculated at the opening rate and the liability is calculated at the closing rate. Okay, so now there's one more question by the name of trailer. Let's solve this. In this, the question says that the following information relates to the group pension plan of trailer. In this, we have a fair value of plan asset opening 28, closing 29. We have a value of defined benefit obligation, which is 30 and 35. And on the next page, if you see, we have some space to write down the answer. So if I make a line over here, okay, I don't have space to make a line. So if I prepare the table over here, we have the opening of 28 plan asset, DBO opening of 30, closing of 35, plan asset opening of 28, closing of 29. Godfrey is saying, why are we not solving the question of Zippy? Godfrey, you have to try that question on your own, and you and you can post your answer on the group so that we can have the discussion over there. Just to save time, I have skipped a question. It is one of the easy questions, so it will not be a challenge for you people to try it your own. Yes, Iraj, you have got the right point. Now the question says that the contribution for the period received by the fund were $2 million. So the contribution should be added in the fund, the plan asset, and the employee benefits paid in the year amounted to 3 million. So benefits paid should be reduced from both the plan asset and the DBO. The discount rate to be used in any calculation is 5%. So 5% of 30 is 1.5 and 5% of 28 is 1.4. The current service cost for the period based on actuarial calculation is $1 million. So 1 million should be added to the DBO. The above figures have not been taken into account for the year ended 31st May 2013. So the question has not taken into account all these areas except for the contribution paid which have been entered in cash and the defined benefit obligation. So now we need to calculate the balancing figure as the remeasurement gain or loss. So let's use the calculator for this. We have 30 plus 1.5 plus 1 minus 3 is going to be 29.5, which means we are going to increase the liability by 5.5. So this is a loss. And for the asset, it's 28 plus 1.4 plus 2 minus 3, which is 28.4. And 29 minus 28.4 is going to be 0.6. So 0.6 is the remeasurement gain because it's a positive value. So the net liability is going to be 2, 0.1, 1, negative 2, 0, 4.9, and 6. So if we take the values in the P&L, the interest and the current service cost is going to be taken to the P&L. 4.9 will be taken to the OCI. 2 will be credited from the bank. So the entry is going to be P&L debit by 1.1, OCI debit by 4.9, the bank should be credited by 2, and the non-current liability should be credited by 4, from 2 to 6, which means an increase of 4. So this is how we were supposed to recognize the entry for this question. So IAS 19 defined benefit plan accounting is comparatively an easier one. You need to follow the format, you need to identify the values, prepare the entry, and that's it. Any question in this? So we have already written a similar question to this one. So I'm moving forward because as per the target, we have 8 minutes to complete IAS 19 and then move towards IFRS 2. Because I had planned the time till 10, which means we have actually 8 hours for three standards, actually 19, IFRS 2 and IAS 12, 4 hours for today, 4 hours for the next. So approximately 2 hours for 19, 2 hours for IFRS 2, 2 hours for IAS 12. And at the end, when we save time, we're going to invest 1 hour for some other standards as well. So now we have another question by the name of Kate. Let's read this. This is a section B type question. All of the other that we have done so far was section A type questions. So this is an older question, but a very important one. Let's try this. The question says that in 2010 financial statements, Kate disclosed the existence of a voluntary fund established in order to provide a post-retirement benefit plan. Kate considers its contribution to the plan to be voluntary. Kate considers the contribution to be voluntary and has not recorded any related liability. So Kate has not recorded any liability in its consolidated financial statements. Kate has a history of paying benefits to its former employees, even increasing them to keep pace with inflation since the commencement of the plan. So Kate has a history of paying benefits to the employee. This is actually creating a constructive obligation on Kate to do this in the later years as well. So even if Kate does not have a legal obligation, it do have a constructive obligation to pay benefits, not the contribution. The word says the benefits. The main characteristics of the plan are as follows. So now the characteristics are that the plan is totally funded by Kate, which means no amount is being deducted from the employees. Contribution for the plan are made periodically. The post-retirement benefit is calculated based on the percentage of final salaries. If you see, the benefit is calculated based on a predefined formula, which means this is a defined benefit plan because we are going to pay this amount irrespective of whether the fund has the amount or not. The annual contribution The annual contribution to the plan are determined as a function of the fair value of the assets less the liability arising from past service. So these 3 points were not relevant to us. These are not the points based on which we identify whether the plan is contribution or benefit. So for us, the only relevant point was this one. Kate argues that it should not have to recognize the plan. Kate is arguing that it should not have recognized the plan because according to the underlying contract, according to the contract, it can terminate its contribution to the plan if and when it wishes. So the contract is actually allowing Kate to cancel the contract whenever it wishes. The termination clause of the contract established that Kate must immediately purchase lifetime annuities from an insurance company for all the retired employees who are already receiving benefit when the termination of the contribution is communicated. So if Kate actually terminates the contract, it can still not save itself from a cash outflow. Rather, Kate will still have to purchase the lifetime annuities for the employees, so it still has to incur a cash outflow. And if we see, this is something written in the contract, so this is also a legal obligation on Kate. So as this is a legal obligation and Kate already has a constructive obligation, Kate should be recognizing the plan in its balance sheet. So it's a 5-mark question. Let's write down the answer on the next slide. That as per IAS 19, Post-retirement benefits are either a defined contribution plan or a defined benefit plan. In case where an entity pays fixed contribution and has no further legal or constructive obligation with investment risk and actuarial risk being transferred to employee or third party are treated as a defined contribution plan, and plans which are not classed as contribution plan are a defined benefit plan. So this is the first paragraph, which is normally the paragraph for the rules. And now we are going to apply onto the case. In case of Kate, it has a past practice of providing benefit to its employees, former employees. This creates a constructive obligation on Kate to provide such benefits in the future too. Further, as per the contract, if Kate terminates the contribution, it has to purchase lifetime annuities from an insurance company, which means Kate has no option to save itself from a cash outflow. Therefore, has an obligation which should be recognized as a liability. Now we are going to conclude. Okay, plans which are not classed as contribution plan are a defined benefit plan. Thank you, Gania. Now, as Kate has both legal and constructive obligation, it should treat the plan as a defined benefit plan. Also, there's one more thing which we need to write. As the benefit to be paid is a predefined formula, the plan should be treated as a defined benefit plan because Kate has to pay the amount as per the formula irrespective of the amount of its contribution. So this means, therefore, investment risk belongs to Kate. So now we are concluding and we are saying that as Kate has both legal and constructive obligation, it should treat and bears the investment risk it should treat the plan as a defined benefit plan. Okay, Roshan is saying how we can extract professional marks given. Roshan, the professional marks will not be there in case of accounting standards and consolidation. The professional marks will only be there in case of ethics and analysis. So two professional marks for ethics and two professional marks for analysis. Apart from that, there are no professional marks in the SBR exam. Okay, Musharraf is saying, can you show us the marking system of the question? Musharraf, basically every single relevant point is of 1 mark. Every single relevant point is of 1 mark. Like for example, we have written that post-retirement plan are either a defined contribution or a benefit. So we have got one. In which case we treat it as contribution plan is 1 mark. When we treat it as benefit is 1 mark. And then we are going to apply it. But if you are not applying it onto the scenario, the examiner will not give you passing marks. So the application is very important in the exam. Even if you're not concluding it properly, if you have applied it, you have showed the knowledge, you're going to get sufficient marks. So that was all with IAS 19. Now we're going to start the area of IFRS 2. IFRS 2 is by the name of share-based payments. So we'll be starting it today, but we'll be completing it tomorrow. So IFRS 2 is by the name of share-based payments. Now, when we talk about the share-based payments, these are of 3 types. Either it is going to be an equity settle, or a cash settle, or a cash alternative. Share-based payment means that we are receiving goods or services, and in return, we are going to pay an amount which is based on the shares. So if it's getting settled in shares, we're going to call this equity settled. If the price is based on shares but settled in cash, so we are going to say it is a cash settle. So where goods or services are received against issuance of shares is called equity settled. It is saying, sir, should we give conclusion statement for every question? It is not necessarily. If you know a specific conclusion, do give it. If you don't know a specific conclusion, you can write it along with the answer. But it's better to conclude the answer in one direction. Cash settle means where goods or services are received against cash based on the share price. So if we are purchasing, let's say $10,000, 10,000 units of inventory, and in return we are going to give our own shares, let's say 10,000 shares. So this means we are receiving the goods, we are giving the shares, so it is going to be an equity settled share-based payment transaction. It is going to be an equity settled share-based payment transaction. And if we are giving cash, which is equivalent to 10,000 shares, if we are giving cash equivalent to 10,000 shares, this will become cash settled because the cash is still based on the shares, but it is going to be settled in cash. We are not giving the shares, we are giving the cash, but that cash is also based on the shares. That is why we are calling this cash settled share-based payment transaction. And in cash alternative, either the entity or the counterparty will have the right to demand either shares or cash. So in this, either the entity or the counterparty will have an option to decide whether they want to settle in cash or they want to settle in shares. It is saying for equity settled share-based payment transaction, how do we differentiate this from IFRS 9 transactions? Basically, it is that simple. If the number of shares are fixed, it's IFRS 2. If the number of shares are variable, it is going to be IFRS 9. If the number of shares are variable, it is going to be IFRS 9. And if the number of shares are fixed, it is going to be IFRS 2. That's pretty simple. Okay, so now we are starting the discussion from equity settled share-based payment transactions. In this, we need to understand three areas. We need to understand the entry, what should be debited, what should be credited. We need to understand the measurement, by what amount the debit and credit should be done. We need to understand the measurement date, that which the value at which date should be taken for the purpose of recognizing the entry. Now the first thing is the entry, which is going to be the asset debit or the expense debit and the equity credit. If we are receiving goods, if we are receiving plant, we are going to debit the asset. If we are receiving services, we are going to debit the expense. So if we are receiving goods, we are going to record that as an asset. If we are receiving services, we are going to recognize that as an expense. And we are going to create a temporary reserve in the equity by the name of share-based payment reserve. So initially the entry is the asset or the expense debit and the share-based payment reserve credit. Subsequently, when we issue the shares, we actually debit and eliminate the share-based payment reserve, and instead we recognize the share capital and the premium. We eliminate the share-based payment reserve and then we recognize the share capital and the share premium. Now, if we see, all these areas are a part of equity. So in simple words, we say that we should be debiting the asset or the expense and we should be crediting the equity. In simple words, we can say we should be debiting the asset or the expense and we should be crediting the equity. Now the second question is that the debit and the credit should be by which amount? So we say that direct measurement is the preferable method, which means the entry should be made by the fair value of the goods or services that we are receiving. So in my previous example, if I go back, where we were buying 10,000 units of inventory and giving 10,000 shares. Now let's say if the inventory is $10 each and the shares are $8 each. So now we are acquiring the inventory of $80,000, sorry, $100,000, but the shares we are issuing are of $80,000. So by which amount are we going to recognize the entry? The entry is going to be recognized by the value of the goods by $100,000, because it is preferable to recognize the direct measurement, which is the fair value of the goods or services that we have received. But in case if the fair value of the goods or services received cannot be measured reliably, then we are going to follow the indirect measurement. Only when direct measurement is not possible. So if the direct measurement is not possible, only in that case we are going to follow the indirect measurement, where we are going to recognize the entry by the fair value of the equity instrument granted. So in my previous example, the fair value of equity was 80,000. So if we don't know the fair value of 100,000, then we are going to recognize the value at 80,000. But if we know the value of the goods 100,000, we cannot move towards the $80,000. Usman is saying fair value of equity is the par value per share. No, Usman. It is the market value per share, listed price per share. Yes. So fair value means the market value as per IFRS 13. But in case of IFRS 2, the IFRS 13 does not apply. So if we have the value of 10,000, we should $100,000, we should use that. And if we don't have, we are going to use the fair value of the shares. Usman is saying, so if the shares are not listed, Usman, then we need to assess the estimate the value of the shares. So the first option is to make the entry by the direct measurement. If it's not possible, only then we are going to follow the indirect measurement. Now the third question arises that if, let's suppose, I made a contract on 1st January that I'm going to receive goods on 30th June. We are going to receive the goods on 30th June and we are going to issue the shares on 31st December. We have made a contract in January that we are going to receive the goods in June and we are going to issue the shares in December. Now, fair value at which date should be used to recognize the entry? Fair value at which date should be used to recognize the entry? Okay, Krishna is saying 1st January, which means the contract date. Corona is saying the transaction date. Iraj and Shahzad is saying 30th June. And Gania is saying goods received. Yes, basically we are going to use the value at 30th June. We are going to use the value at 30th June because we should be using the date when the goods or services are received. This should be the date at which we should use the fair value. So this applies to every case other than employees. In case of employees, we are going to use the grant date, which means the contract date, the promise date, the grant date. So in every case, we should be using the date at which we are receiving the goods and services, but only in case of employees, we are going to use the grant date. Okay, now there's one question. Can you try it quickly and then we are going to solve it together? Just read the question quickly in 2 minutes and try it on your own that what should be done in this case. Okay, so have you people tried the question? The question says that Greeny has issued 1 million shares of $1 nominal value for the acquisition of franchise right. So we have acquired a franchise right, which is an intangible asset, and in return we have issued our own 1 million shares. From here we have identified that this is a case of IFRS 2 because we are acquiring the goods and we are paying them in shares. Hiba has made an entry of asset debit by 2.3, share capital by 1, and premium by 1.3. Okay, and Ghania is also saying the same. Krishna is saying, sir, do there is a financial liability element. Let's see, Krishna. Let's read the entire question and then discuss. Similar franchise rights are sold in cash transactions on a regular basis. So these type of rights can also be acquired in cash. And Greeny has been offered a similar franchise right at another airport for $2.3 million. So this means this is the fair value of the franchise right because it is being available in the market at this price. The price is consistent with other prices given the market condition. So this also says that this is the market price. The shares of Greeny, the share price of Greeny was $2.5 at the date of transaction, and Greeny wishes to record the transaction at the nominal value of the shares. So Greeny is wishing to value at the nominal value. Is it possible to measure at nominal value? Obviously not. So we are going to say that as Greeny has acquired the franchise right against the issuance of shares, it should be treated as a share based payment transaction under IFRS 2, where the franchise right should be recorded against the corresponding increase in equity. This is how we are writing the double entry. Franchise right should be recorded against a corresponding increase in the equity. Okay, at the fair value of the franchise right, which is $2.3 million. If the fair value of the franchise right could not have been measured reliably, in that case, it would have been recognized at $2.5 million. In any case, the transaction cannot be recorded at the nominal value of the shares. So this is how we have written the correct answer of the case. That first we have identified why it is or how it is IFRS 2. Then we have written the entry, and then we have mentioned the measurement, and then we have mentioned, in fact, we haven't mentioned the measurement date, even we could have. And then we have written that if direct measurement was not possible, then what could be done? And then we have written an answer to the question that the question wanted, Green wanted to recognize at the nominal value. So we have said that it cannot recognize at the nominal value of the shares. Getting the point so far? Okay, so now let's discuss the next area, which is the grant type. This basically applies to the case of employees only. That what types of grant are there in case of a share-based payment? So there are two types of grant. Either the share-based payment is going to be a conditional grant or an unconditional grant. Unconditional grant means we are giving shares without any condition. We are giving shares without any condition. So this is sort of a bonus that when someone works good, we pay a bonus at the end. So similarly, if we think that the employees have worked very hard in the previous year, we may offer them an unconditional grant, simply issuing them shares without any condition, because we want to compensate them for their good performance in the past. The second type of grant is a conditional grant where there's some condition which is going to apply. And the conditions are of two types. Either it is going to be a vesting condition or a non-vesting condition. Now, what is a vesting and a non-vesting condition? Condition before the issuance of shares is called vesting condition. Condition after the issuance of shares is called non-vesting condition. Like for example, if we give shares to the employees and we say that you cannot sell them for the next 3 years. We are giving shares to the employees and we are saying that you cannot sell them for the next 3 years. Which type of condition is this? Vesting or non-vesting? We are giving you shares but you cannot sell them. Is this a vesting condition or a non-vesting condition? Shahzad is saying vesting, Raj is saying vesting, Krishna is saying vesting, Usman is saying non-vesting. Okay, basically this is a non-vesting condition. Hiba is also saying non-vesting. Because we are going to give you shares, you cannot sell them for 3 years. This means we are giving the shares first and then we are applying the condition. So it's a non-vesting condition. We are giving shares to the employees, but they cannot sell them for the next 3 years. This means the condition is applying after giving them the shares. So it is going to be a non-vesting condition. Getting the point, everyone? We are giving the shares, but they cannot sell them. This means it's a condition after the issuance of shares. But if we say to the employee that if you work for 3 years, we are going to give you shares. If you work in the company for 3 years, we are going to give you shares. I'm repeating, if an employee works for 3 years in the company, we are going to give shares. Is this a vesting condition or a non-vesting condition? Okay, yes, everyone is saying vesting this time because the employee has to work first and then get the shares. First, we have to work and then we are going to get the shares. So this is a condition which needs to be met before the employee gets the shares. And if we say that we are giving shares to employees, but they are not going to receive dividend for the next 3 years. We are giving shares to employee, but they are not going to get a dividend for the next 3 years. Is this a vesting condition or a non-vesting one? We are giving shares to the employees, but they are not going to receive a dividend for the next 3 years. Okay, majority people are saying non-vesting, but there are some people saying vesting too. Basically, this is again a non-vesting condition because we are giving shares and then you are not going to receive the dividend. So the condition is applying after the issuance of shares. First we are giving shares and then the condition applies. So we need to check what is to be done. Like for example, I'm writing it down. We are giving you shares, but you cannot sell. So this means the shares are given first and then they cannot sell. So it's a non-vesting. We are giving you shares and you are not going to receive a dividend for the next 3 years. So this means again non-vesting because we have given the shares and then the condition applies. If you work for 3 years, you are going to get shares. So this means this is a vesting condition. If you make sales reach $200 million, we are going to give you shares. If you make the company reach a sales of $200 million, you are going to get shares. Is this vesting or non-vesting? If the sales reaches $200 million, we are going to give employee shares. Vesting or non-vesting? Yes, everyone is saying vesting. Yes, this is a vesting condition now. Because first you have to show the sales and then you're going to get the shares. So it's a vesting condition. Now the vesting conditions are of further two types, a service condition and a performance condition. Service condition means working in a company for X years. Service condition means working for X number of years. So if we are asking an employee to work for 3 years, get the shares, it's a service condition. The first one was a service condition, that if you don't leave the company for 3 years, we are going to give you shares. So it is a service condition. If you don't leave the company for 3 years, we are going to give you shares. It's a vesting condition, which is a service condition. And the sales target was a performance condition, which is based on the performance of the employee. So reaching a sales and then receiving the shares is a performance condition. So even in performance condition, we have two types of conditions. Either a market condition or a non-market condition. Market condition means any condition linked to the share price, such as any market value condition. If the market value reaches $10, we are going to give you shares. This is a market condition. If the PE ratio reaches 10 times, we are going to give you shares. PE ratio means market value divided by EPS. So it is also based on the market value. And any condition which is not linked with the share price is a non-market condition, such as sales targets, such as profit targets, such as EPS targets. All of these are non-market conditions because they do not depend on the market value. Although market value does depend on these. The market value depends on the sales, profit, and the EPS, but these three conditions do not depend upon the market value. So any condition which is depending on the market value is a market condition, and any value which is not depending on the market value is a non-vesting condition. Non-market condition, sorry. Now, what do we do in case of unconditional grant and in case of non-vesting condition? We recognize the expense immediately. In case of unconditional and non-vesting condition, we recognize the expense immediately. Because in both the cases, we are giving immediate shares. And we are giving shares immediately, we should be recognizing the expense immediately too. If we are giving the shares immediately, we should be recognizing the expense immediately too. But what accounting is done in case of these conditions? We are going to discuss this in the next slide. So if the condition is non-vesting or if the condition is unconditional, we expense it out immediately. Now we have an example of a service condition, which is example 1, where the question says that we have 1200 employees and we have promised them to give them 300 shares per employee. We have promised to 1200 employees that we're going to give them 300 shares, and there's a vesting condition that they have to work for 3 years first, and then they are going to get the shares. First, they have to work for 3 years, and then they are going to get the shares. Now the question says that the expected number of employees to vest. Expected number of employees to vest is at grant date we are expecting 75% of them to vest. In year 1 we are expecting 80% of them to vest. In year 2 90%. In actual there are 1,000 of them. And the fair value is 15, 16, 17 and 18. Which value do you think we should be using to recognize the expense? Which value do you think we should be using to recognize the expense? Should we use 15? Should we use 16, 17 or 18? Okay, everyone is saying the right. We should be using 15 because in case of employees, if I go back, in case of employees, the measurement date was the grant date. This is the area. In case of employees, the measurement date is the grant date. So we should be using the value as 15. So all rest of the values are actually not relevant to us. All of these values are not relevant to us. Only $15 is the relevant value. Now, how do we calculate the expense? Is that in year 1 we had 1200 employees and we have promised them 300 shares per employee, and 80% of them are expected to vest, and each share is of $15. So we have promised to 1200 employees that we are going to give them 300 shares, but only 80% of them will actually vest. That is why we are recognizing the expense of only 80%. And each share is of $15. So this is the total expense we should be recognizing. And this is an expense which should be recognized over 3 years. That is why we are multiplying by 1 divided by 3. So what amount are we getting for this? Can you people use the calculator and let me know? Okay, so it's 1.44 million. Thank you. So 1.44 million is the expense for the year and the accumulated expense. Now in year 2, how are we going to calculate 1200 into 300 into 90% into 15 into 2 by 3? Because if we multiply by 2 by 3, we are going to get the accumulated expense for 2 years. We're going to get the accumulated expense for 2 years, and this is what amount? 3.24. Thank you. So if the accumulated expense is 3.24, the for the year expense is going to be get 1.8 million. So for the year is basically 3.24 minus 1.8. 44. This is how we are getting 1.8 million. Similarly, in year 3, we know that there are 1,000 employees who have actually vested. And we are going to give them how many shares? 300 of them. So 1,000 into 300 into 15 into 3 by 3. So this is going to be 4.5 million, and the difference is going to be $1.26 million for the year. And how we get 1.36? 4.5 minus 3.24 is the value. We have got 1.26 million. So this is how we have calculated the expense for all of the 3 years, and the entry for every year is going to be expense debit and the equity credit. By equity, we mean the share-based payment reserve. So in year 1, the entry is going to be by 1.44. In year 2, the entry is going to be 1.8 million. In year 3, it is going to be by 1.26 million. So this is how our entries for year 1, 2, and 3 are going to be prepared. Okay, now Laura has a question that is it correct that if the employees are expected to leave, example 10 in year 2, 10 in year 3, you would use the appropriate fair value of 17, 18? No, Laura, basically I've understood your question, and Iraj is also asking same sort of question. If I go a bit further, there's a question of such type which we have to solve. Let me find that question. Okay, yes, here it is. So let's solve this question just to answer what Laura and Iraj are asking, because this is something which is there in multiple past papers. So let's solve this question beforehand, although it was planned to solve in the later slides, but let's solve it. The question says that Beth granted 200 share options to each of its 10,000 employees on 1st December 2006. So this is the date, 1st December 2006. The shares vest if the employees work for the group for the next 2 years. So this means this is the vesting condition, which is a service condition. So we have a service condition of 2 years. On 1st December 2006, which means at the grant date, Beth estimates that there would be 1,000 eligible employees leaving in each year up to the vesting date. But this is an estimate on the grant date, and we are not going to use the estimate on the grant date. If I go back on my current slide, I have to skip a lot of slides in between. So if we see, we haven't used this 75%. We have directly used 80, 90, and 1,000. So the estimated number of employees to vest will never be used in any case. Getting the point? So this 1,000 has no use so far. Then the question further says that at 30th November 2007, which means at the year end, now the estimate on this date is going to be important for us. 600 eligible employees had left the company. So till over here, 600 people have left out of how much? Out of 10,000. The estimate number of employees leaving in the year to 30th November 2008 was 500 at 30th November 2007. So on this date, we are expecting a further 500 employees to leave by 30th November 2008. So on this date, the estimated number of employees to vest are 10,000 minus 600 minus 500, which is going to be 8,900. So on 30th November 2007, we are expecting 8,900 employees to vest. Now the question says that the fair value of each option at the grant date was $10. So this means that 8,900 employees are the expected number of employees to vest. Iraj is saying, and at 30th November 2008, also 1,800. Iraj, we cannot calculate the value at November 2008 because this 500 is an estimated one. So this question's requirement was originally to calculate 2007 expense only. Because if the question wants 2008 expense, then he will have to give us the actual number of employees who have left in 2008. Because after deducting that, we can be able to know the exact number of employees who have vested. So 8,900 into 10 into 200 options we have granted. To 8,900 people, we have granted 200 options for $10 each. It is just saying, so we will minus actual number with 8,900. Iraj, we will see a question which is going to ask us expense for the multiple years. So your question will be more refined in that one. So into 1 by 2, because this is the expense for 2 years, which is going to give us a value of $8.9 million. So Laura, I think your question has been answered over here. If not, you can ask again. That this is how we should be answering the question of IFRS 2, and now I'm going to write it down that as per IFRS 2, or we can even say that the share options granted by Beth to its employees is an equity settled share based payment transaction where expense should be recognized over the vesting period against a corresponding increase in equity. So we are actually writing down the treatment of the answer, and the admin is asking for a quick feedback about today's session. So I'm giving you people 2 minutes to provide the feedback quickly. Okay, thank you everyone. Thank you for the feedback, and I'm happy to see the good feedback. And normally your positive feedback actually motivates us more to when we see that it is helpful for people, we get more motivated to invest more energy into that. Okay, so let's continue now that we were writing that the share options granted by Beth to its employees is an equity settled share-based payment transaction where the expense should be recognized over the vesting period against a corresponding increase in equity at the fair value of the options granted at the fair value at grant date. We can even say that the fair value of the options at the grant date. And then we are going to apply it onto the scenario that Beth should recognize the expense of $8.9 million. We can say Beth should recognize the expense incorporating the expected number of employees to West being 8,900 with the fair value of each option being 200 sorry $10 spread it over to 2 years, which will result in an expense of $8.9 million. So this is how we have actually applied onto the case of Beth. Is it clear so far? So let's get back to the area where we were actually. Okay, so now we have completed the example one relating to the service condition. Let's move on to the next slide. Now we are going to discuss the treatment of performance condition. When we talk about performance condition, we have two types of conditions: a market condition and a non-market condition, which we have already discussed previously. In case of non-market condition, we are going to recognize the expense if the condition is expected to be met. We're going to recognize the expense if the condition is expected to be met. Otherwise, any previously recognized expense is reversed. This means if the condition is meeting, we are going to recognize the expense. And if the condition is not meeting, we are going to reverse the previously recognized expense. But in case of a market condition, what will happen? The expense is recorded irrespective of whether the condition is expected to be met or not. So if the market condition is expected to be met, we are going to recognize the expense. If it's not expected to be met, we are still going to recognize it as an expense. Why? The reason is that market condition is not substantially controlled by employees, because basically a lot of other macroeconomic factors also apply onto the market condition, because the market value may change because of a lot of reasons. Even if the value of the dollar changes, the stock markets actually change. So now the employee has nothing to do with the value of the dollar. So the market condition are going to be affected by a lot of macroeconomic factors, That is why we say that it's not substantially controlled by the employees. But the non-market condition is substantially depending or controls by the employees. That the non-market condition substantially depends on the employee's efforts, but the market condition, they are not substantially affected only by the employee's efforts, because the market value changes every day, every hour, every minute. Is it reflecting the employee's efforts every minute? Obviously not. It is actually reflecting the macroeconomic factors. Only at the time of publishing of the financial statements, only at the time of the publishing of financial statements, the actual value reflects. Otherwise, the remaining 364 days, the price reflecting in the stock exchange is not depending on the company's performance. It is being affected by other factors. So as this is not completely depending on employees' efforts, we say if it's meeting, we are going to recognize the expense. If it's not, we are still going to recognize the expense, assuming that the employee made the effort, but the condition is not met because of some other reason. Iraj is saying, so we will reverse the entire treatment expense, debit, equity, credit. No, Iraj, basically, we will reverse in this case. In non-market condition, we are going to debit the equity and we are going to credit the expense. But in case of market condition, if it's not met, we are still going to recognize the expense. If it's meeting, expense. If it's not meeting, still expense. Now let's solve one question quickly. This is probably going to be the last question for today. And the question says that we have 600 employees with 1,000 shares being granted to each of them. There's a 3-year service condition and there's a non-market condition that the sales should reach $200 million. Now the question is entirely the same, only new information is this that we have. That at grant date, we are expecting the condition to met. In year 1, we are expecting the condition to met. So we should be recognizing expense in year 1. In year 2, we are expecting the condition to be met. So we should again recognize the expense in year 2. But in year 3, the condition is not met. So in year 3, what we are going to do, we are going to reverse the previously recognized expense. So if we calculate that, we are going to say there are 600 employees with 1,000 shares and 90% expected to vest into $15 because all rest values are irrelevant. And this is the expense for how many years? 3 years. So can you check the value of this? I think it's 2.7 million. Can someone calculate the amount of the expense? Yes, it's 2.7 million. Okay. So 2.7 million is the amount of the expense for the year and the accumulated expense. Now in the second year, we are going to say 600 into 1000 into 75% into 15 into 2 by 3. So what is the value of this one? $4.5 million. Thank you, Raj. And thank you, Krishna. So the expense for the year is going to be 1.8. But in year 3, if we see the condition is not met, so what we should do, we should reverse the expense of 4.5 and bring the accumulated expense to 0. So in year 1, we are making the entry as expense debit, equity credit by 2.7. In year 2, we are making the same entry by 1.8. But in year 3, we are actually reversing the entry. In year 3, we are reversing the entry by making equity debit and the expense credit by 4.5 million. So this is how we are going to recognize the entries in case of example 2. So that was all for today's session. We are up with the time and we're going to continue from example number 3 tomorrow. And tomorrow's timing are going to be the same, 7 p.m. to 11 p.m. And if you people have any question, you can ask it on the WhatsApp group. But tomorrow I have a lot of classes, so most probably I will be replying to your queries on Monday probably. So I will reply to the WhatsApp group links today, and for the queries we will have to wait till Monday. Okay, so thank you everyone. And Gani has a question, but the time's up, so let's discuss this in the next session. So thank you everyone. Take care and see you all tomorrow. Till then, Allah Hafiz.